Imagine buying a newly built house, right? But you pay less for the entire property than what the raw bricks, the copper pipes, and like the wooden beams actually cost.
Right, which sounds completely impossible.
Exactly.
Yeah.
But if you bulldoze the house tomorrow and just sold off the scrap materials, you would actually walk away with a profit.
Yeah, you'd make money just selling the parts.
Right. It sounds like this impossible real estate scenario, but today, that is exactly how the stock market is treating one of the biggest search and artificial intelligence giants in the world. So welcome to another deep dive.
Thanks. Yeah, we are turning our attention to Baidu today.
Yes, the Chinese tech titan.
Exactly. It's mid-August 2026 right now. And the situation unfolding with Baidu is, well, it's honestly one of the most fascinating market paradoxes we've seen in years.
It really is.
We have this huge stack of equity research to go through today. We're pulling from recent SEC filings, FinHub market metrics, and some incredibly telling global news out of the AI and autonomous driving sectors.
And the mission for this deep dive is to answer a very urgent question for you. Is Baidu a dying legacy company caught in a terminal downward spiral that the market has correctly priced for death? Or, are they a deeply misunderstood innovator on the absolute verge of a massive physical AI revolution?
That's the million-dollar question.
Right. Okay, let's unpack this.
Yeah. So to understand the sheer scale of the identity crisis happening at Baidu right now, we really have to start by looking at the brutal reality of their balance sheet.
Which is rough.
It is. The numbers we are seeing as of this month, August 2026, they paint a picture of a company operating under immense, almost unprecedented pressure from every conceivable angle.
Yeah, I was looking at Baidu's stock chart in the research, and I mean, it looks like a black diamond ski slope.
That's a good way to put it.
How bad is the technical damage here before we even get to the business fundamentals?
Well, it is in a complete technical freefall. So as of August 13th, the stock is sitting at $104.68. Right. And over the last 13 weeks alone, it is down over 25%.
Just in 13 weeks.
Yeah. And from a charting perspective, it is broken down through its 20-day, its 50-day, and crucially, its 200-day moving averages.
And breaking that 200-day line is bad, right?
Yeah, it's terrible.
Yeah.
It essentially signals that long-term institutional holders are just giving up and heading for the exits.
Which brings us back to that real estate analogy from the beginning, because the metric that absolutely jumped off the page for me is their price-to-book ratio.
Oh, yeah.
The research shows the PV ratio is sitting at 0.9009.
Which is an incredibly rare phenomenon for a technology company of this scale.
Unheard of, really.
Yeah, I mean, the price-to-book ratio compares the market's valuation of a company to its actual accounting value, right? So it's assets minus its liabilities.
Right.
A ratio below 1.0 means the stock is trading for less than its liquidation value.
So the market is effectively stating that Baidu's future operations are expected to, destroy value rather than create it.
Exactly. They believe the ongoing business is worth less than the sum of its raw static parts.
But, a cheap house is not a good deal if the foundation is actively crumbling.
Right.
When you look at the top-line revenue trajectory, you can see why the market is so pessimistic. The legacy search and advertising business appears to be completely stagnating.
Yeah, the growth is just gone.
In fiscal year 2023, they brought in $18.958 billion. Then it dropped down to $18.38 billion in 2024.
Mm-hmm.
And for fiscal year 2025, it just hovered slightly higher at $18.458 billion. I mean, they're just treading water.
The top line is treading water for sure, but the bottom line has completely fallen through the floor.
Yeah,
We are looking at a catastrophic profit collapse. I mean, net income crashed from $3.255 billion in fiscal year 2024.
which is a solid number.
Right, but then it dropped to just $799 million in fiscal year 2025.
That is a staggering evaporation of profit. And I guess that explains the bizarre valuation multiples we are seeing.
Exactly.
Because of that massive drop in trailing earnings, their price-to-earnings ratio, the PE, has spiked to an absurd 619.54.
682.
Usually, a healthy tech company trades at a PE of maybe 20 or 30, meaning you are paying 20 times their annual earnings for a share.
Right.
A PE over 600 means the earnings have essentially vanished relative to the stock price.
What's fascinating here is how the bleeding is happening on two completely different financial fronts. So we kind of have to separate them to understand the true crisis here.
Okay, let's do that.
So you have the margin compression on the income statement, and then you have this massive drain on the cash flow statement.
Right, let's break those down, maybe starting with the margins.
Yeah.
The sources show Baidu still maintains a gross margin of 42.08%. So that tells us their core products still have a very healthy markup at the top level. But by the time you get to the bottom line, the net margin is a microscopic 0.3%.
It's tiny.
What mechanism is eating 41% of their revenue before it can even become profit?
Well, that net margin crush is heavily driven by their daily operating expenses.
Okay.
You're looking at massive research and development costs, paying salaries for top-tier AI engineers, running daily operations, marketing, administrative overhead.
Sure, all the day-to-day stuff.
Exactly. The sheer cost of trying to maintain their market share in a really highly competitive Chinese tech environment is just consuming nearly every dollar of gross profit they generate.
So the daily operations are eating the net margin, but then I look at the cash flow statement and things look even more dire, honestly.
Yeah, they do.
Operating cash flow completely flipped. It went from nearly $3 billion positive in 2024 to negative $431 million in 2025.
Which is just a brutal swing.
How do you go from generating $3 billion in cash to burning $500 million in a single year?
That is the second front of the bleeding.
Yeah.
So while R&D hits the net margin, the cash flow is being devastated by capital expenditure or CapEx.
Right.
The SEC filings in our sources reveal that Baidu's CapEx skyrocketed to $1.726 billion in fiscal year 2025.
Wow.
Yeah, and this isn't paying employee salaries. This is buying the physical NVIDIA chips, building massive data centers, and acquiring the heavy hardware required to train and run massive artificial intelligence models.
And because of that $1.7 billion structural spend, their free cash flow proxy for 2025 went deeply negative, right? Hitting minus $2.157 billion.
Exactly.
Which brings us to the elephant in the room here, artificial intelligence.
Right, AI.
Because we have been told for years by the financial industry that AI is like a license to print money.
Oh yeah, the ultimate cash cow.
It is supposed to be software with infinite scale. So how on earth can intelligence be causing a massive cash burn?
Well, in a normal software environment, you build a program once and you sell it 1,000,000 times with zero marginal cost, right?
Yeah, like an app.
Exactly. But generative AI requires constant, massive computational power every single time a user asks a question.
It has to think every time.
Yes. And in the Chinese market right now, the competitive landscape has turned totally brutal.
Yeah, the market news in our sources talks about a fierce price war, specifically noting that competitor models like DeepSeek and Qwen 3.8 Max are actively, and this is a quote, collapsing the cost of intelligence.
It's a great phrase.
But I am struggling with the mechanics here. Isn't more advanced intelligence supposed to command a higher premium? Like, how does it become deflationary?
We're witnessing the rapid commoditization of AI. I mean, think of it like electricity.
Okay.
The underlying architecture for these large language models is becoming somewhat standardized across the industry. So competitors like DeepSeek don't necessarily need a massive generational technological breakthrough to steal market share.
What do they do instead?
They just heavily subsidize the computing power on their end and completely slash the API prices they charge developers to access their models.
Oh, I see. So if a developer is building an app and needs an AI backend, they look at Baidu's price, they look at DeepSeek's heavily discounted price, and since the output is relatively similar in quality, they just go with the cheaper option.
Exactly. The dynamic playing out. It forces Baidu to match those bottom barrel prices just to keep developers inside their ecosystem.
Because they can't afford to lose the users.
Right. And that deflationary pricing pressure compresses the revenue you can generate per unit of intelligence.
The math on that is terrifying for Baidu's balance sheet.
It really is.
Because on one side of the ledger, they have massive fixed infrastructure costs, like that $1.7 billion CapEx furnace just to build and maintain the AI data centers.
Yep.
But on the exact opposite side of the ledger, the price they can actually charge customers to use that infrastructure is collapsing towards zero.
Their investments are yielding rapidly diminishing returns. I mean, they're caught in a cycle where they have to spend billions just to stay relevant. But the revenue they get back from that spend is shrinking by the day.
It's a race to the bottom.
It is a zero-margin bloodbath.
So If software AI is becoming a purely commoditized utility, they cannot survive playing that game alone. They need a pivot.
Definitely.
They need a real-world physical AI application, something that cannot just be instantly undercut by a cheaper line of code from a competitor. And here's where it gets really interesting.
You were talking about Apollo Go.
Yes.
This is Baidu's autonomous ride-hailing unit.
Yeah.
And it really represents their major strategic play to extend their technological moat out of the digital realm and into physical infrastructure.
We are talking about actual robo-taxis, cars driving themselves through major metropolitan areas.
Yeah, it's wild.
And according to the news sources, Baidu is not just keeping this in mainland China. Apollo Go is officially expanding internationally.
Yes, they are making moves.
They are beginning testing in London, and they are doing it through partnerships with Uber and Lyft. They also just secured a driverless permit in Hong Kong.
And, the partnerships with Uber and Lyft are particularly clever from an operational standpoint.
How so?
Well, Baidu doesn't have to spend billions trying to acquire riders or build a consumer app from scratch in the UK market.
Oh, right. The network is already there.
Exactly. They simply plug their autonomous hardware and software into existing dominant ride-hailing networks.
It really sounds like science fiction coming to life on the streets of global financial hubs.
It does.
And geographically, it makes a lot of sense to diversify out of mainland China to hedge against domestic regulatory and economic risks. But hold on, I am doing the math here on the timeline, and I'm struggling to see how this works financially.
Okay, let's walk through the timeline.
So the sources explicitly note that commercial revenue-generating rides for Apollo Go internationally are targeted for 2027.
All right, 2020.
But we just established that Baidu is burning over $2 billion in free cash flow today, like in the present.
Yeah, the cash burn is happening right now.
How do they survive the next 18 months of an AI price war to even reach that finish line? Is this robo-taxi fleet an actual lifeline? Or is it just a shiny, incredibly expensive science project that they frankly cannot afford right now?
Well, if we connect this to the bigger picture, you are hitting on the exact tension that is currently paralyzing Baidu's stock.
It's a tug of war.
Yes, you have a long-term, highly defensible physical moat in autonomous driving on one side and short-term, severe financial deterioration on the other.
And the market doesn't seem willing to wait around for 2027.
The market is notoriously short-sighted. Apollo Go's future potential is currently entirely unpriced in Baidu's near-term financials.
They don't care about 2 years from now.
No, institutional investors are looking at the negative $431 million operating cash flow happening today. They are looking at the collapsing API margins today. They are not assigning any present value to potential taxi fares in London 2 years from now, because the fears that Baidu might run out of runway before they can even scale it.
Which means time is running out. This tension between the burning core AI business and the futuristic robo-taxi dream is coming to a head in real time.
Yeah, it's all happening right now.
We are sitting here in mid-August 2026, and a series of major catalysts are literally colliding this month. It is a complete gauntlet for them.
And the sentiment heading into this gauntlet is, well, it's grim. Analyst ratings have been incredibly harsh recently. Zacks just downgraded Baidu to a strong sell.
I did notice in the research that JP Morgan still has a price target of $205 on the stock.
That's true.
That is nearly double the current trading price, so there is clearly some institutional hope left that the sum of the parts valuation will eventually be realized. But then I looked at the insider trading activity, and it completely contradicts that optimism.
Insider selling is always a critical metric to watch during an identity crisis like this.
And the SEC filings from just a few days ago, specifically August 10th and 11th, show that insiders dumped over 122,000 shares on the open market.
Wow.
If the company is trading below the cost of its own metaphorical bricks and JP Morgan thinks it could double, why are the executives and insiders running for the exits?
Well, insiders usually sell for a variety of reasons.
Like taxes.
Right. Tax purposes, diversification.
Yeah.
But a dump of that magnitude right before a major earnings report, that signals a profound lack of confidence in the short-term numbers.
Yeah, it does not look good.
And that brings us to catalyst number one. The Q2 2026 earnings report, scheduled to drop on August 18th before the market opens.
The bar for this earnings report is set so low, yet it still feels incredibly dangerous.
Very dangerous.
The analysts expect earnings per share, or EPS, of just $1.19. That would represent a 20.1% decline year over year.
And keep in mind, the market has already priced in a 20% decline.
So where's the risk?
The danger lies in missing that lowered expectation. If they come in worse than expected, it validates the market's deepest fear,
Which is?
that the AI price war cash burn is accelerating much faster than anyone modeled.
And if they manage to survive the August 18th earnings report, they have an even stranger hurdle waiting for them just a week later. Catalyst number 2 is the Extraordinary General Meeting, the EGM, happening on August 26th in Beijing.
Yeah, EGMs are usually called to vote on major structural changes, and this one has 2 massive items on the docket.
The first item is a vote on a dual primary listing in Hong Kong, and mechanically, I understand why they want that.
It's pretty standard.
Yeah, it provides access to mainland capital via Stock Connect programs, and it acts as a hedge against any potential regulatory risks of being delisted in the U.S. It is standard financial maneuvering.
Exactly.
But the second item on the docket is a proposed capital structure change that seems completely contradictory.
The capital structure vote is where the real execution risk lies for investors.
So the board is asking shareholders for a 20% share issuance mandate.
Which is huge.
That means they want the authority to print and sell new shares, which would heavily dilute the value of the stock for existing shareholders.
Right.
But at the exact same meeting, on the exact same day, they are asking for a 10% buyback mandate, which would use company cash to buy shares off the market and support the stock price.
Yeah, it's wild.
So what does this all mean? Why ask for permission to dilute the stock by 20% and buy it back by 10% simultaneously? Aren't they stepping on the gas and the brakes at the same time?
This raises an important question about management signaling and survival tactics. I mean, asking for both a massive issuance and a buyback at the same time is like a ship captain asking the crew to simultaneously patch the lifeboats and drill a hole in the hull.
It makes no sense.
It seems crazy, but it means they want absolute, unchecked flexibility depending on how the next few months play out.
Flexibility for what scenarios exactly?
Well, if the stock drops even further after earnings, and they feel it is absurdly undervalued, they want the power to trigger that 10% buyback to artificially support the floor.
Okay, that part makes sense.
But on the flip side, if the AI price war deepens, or if the Apollo Go rollout requires a sudden injection of billions in new capital to secure those London and Hong Kong markets, they want a loaded gun ready.
To raise cap.
Exactly. They want the power to instantly issue 20% more shares to raise emergency cash, regardless of how much it hurts current shareholders.
To a retail investor, a 20% issuance mandate hanging over the stock is terrifying.
Oh, absolutely.
It caps any potential upside, because the moment the stock rallies, the company might just flood the market with new shares to raise cash.
And that profound uncertainty is why the comprehensive equity research report gives Baidu an overall rating of 4, which translates to neutral, leaning cautious.
Only a 4.
Yeah, a vast majority of the fundamental bad news. The trailing earnings collapse, the negative cash flow, the AI price war. It's already fully priced in. That is the only reason you get a price-to-book ratio of 0.9.
The floor is already built out of scrap material.
Precisely. But the uncertainty of this EGM is a massive psychological overhang. If management aggressively dilutes the stock with that 20% mandate, or if they catastrophically miss the Q2 earnings mark on the 18th, the stock could easily break right through that scrap material floor and discover new lows.
Wow. So to pull all of these complex threads together for you, we are looking at a giant of the technology industry standing at a brutal existential crossroads.
It really is do or die.
We have traced the journey of a company that is currently trading below its own liquidation value, right? It's bleeding cash from immense capital expenditures as it fights a race-to-the-bottom AI price war. And they are betting their entire future survival on physical artificial intelligence, autonomous robotaxis navigating the streets of London and Hong Kong. But to reach that 2027 commercial lifeline, they have to survive a critical, high-stakes gauntlet of shareholder votes and earnings reports right now in August 2026.
Yeah, and if there is one overarching lesson to take away from synthesizing all this data, it is that in the financial markets, cheap does not automatically mean value.
That's a great point.
Just because a stock is trading below its book value does not make it a bargain if the core economic engine of the business is rapidly deteriorating. True value investing requires a tangible operational turnaround, and right now, the burden of proof is entirely on Baidu to show they can stop the cash flow bleeding.
It is a stark reminder of how fast the technological landscape shifts, and, it leaves me with a broader, somewhat chilling thought for you to ponder long after this deep dive ends.
Let's hear it.
Look at the mechanics of what is happening to Baidu's AI monetization right now. If competitors like DeepSeek and Qwen can successfully standardize architecture and basically collapse the cost of intelligence in China today, turning billions of dollars of data center infrastructure into a zero-margin utility just to steal market share, is it only a matter of time before the global AI bubble bursts?
That's entirely possible.
Are we looking at a rapidly approaching future where artificial intelligence isn't some trillion-dollar high-margin software industry, but just a cheap, heavily subsidized utility available to everyone? Think about the underlying economics next time you use a chatbot.
Fascinating stuff.
Thanks for joining us on this deep dive. We'll see you next time.